Welcome to Standard & Poor's November Loan Market Overview Clip. I'm Steve Miller, a member of Standard & Poor's Leveraged Commentary and Data team, a unit that is not part of the ratings agency. For the next 5 minutes or so, I'll walk you through a review of recent loan market trends before winding up with some themes to watch for in the months ahead. For real-time updates on the loan market, please follow LCD on Twitter, Facebook, and LinkedIn. As well, you can download this presentation on slideshare.net. You've seen this before. It's a long and detailed disclaimer. Please read it at your leisure. In October, strong technical conditions pushed loan prices to a 3-year high and drove the S&P LSTA index up 1.6%, its best performance since March. For the same reason, accounts oversubscribed most regular way loans, causing clearing yields to narrow. The market also saw a smattering of more aggressive structures like PIK toggle bonds and covenant-light loans. So far, however, these type of go-go structures are few and far between. In recent weeks, the market has seen a spate of large LBOs, including Cineverse and CommScope. However, arrangers expect relatively light M&A activity in the months ahead, with the action focused mainly on dividends, refinancing, and bond takeouts. If indeed demand remains solid, the loan market's positive bias will therefore persist through year-end. There were no new defaults in October. In response, the default rate receded to 2.3% from a peak of 10.6% 11 months ago. As this chart illustrates, LCD's flow name composite, a measure of the 15 largest, most liquid loans, climbed to a 3-year high of 96.2 on November 2nd from 94.5 at the end of September. Though still about 4% below its pre-credit crunch levels, the composite has now rallied an astonishing 51% from its December 2008 lows. With the secondary on fire, new issues blew out in October. Clearing yields in response declined to a 5-month low of 6.7%. Looking ahead, most players think that new issue yields will continue to grind tighter for the reasons already discussed. In general, arrangers bracket double B clearing yields at 4.5% to 5.5% today, single B plus B1 yields at 5.5% to 6.5%, and B2 yields at 6 to 7.5%. With a 1.6% return in October, the S&P LSTA index was up 8.4% over the first 10 months of 2010. By comparison, the Bank of America Merrill Lynch High Yield Index is up 14.5% year-to-date, while the S&P 500 is up 7.8%. Institutional loan volume dipped to $16 billion in October from a recent high of $20 billion in September. At the same time, investors continue to pour capital into the loan market. Lipper FMI reported another $1.2 billion of inflows into the loan mutual funds in October, and managers say the traffic of institutional allocations from pension fund, endowments, and insurance companies is up meaningfully in the last few months. The combination of strong inflows and weak supply explains why new issue spreads are under assault and secondary prices have climbed in sight of their pre-credit crunch levels. Of course, the market's rally is not all about technicals. Loan market fundamentals continue to improve as well. In October, the loan default rate fell to a 22-month low of 2.3%, about a point and a half inside the historical average. Plunging default rates were brought on by 3 factors. First, an unprecedented burst of corporate bankruptcies during the first quarter of 2009 cleared out many of the weakest issuers. Second, the economic recovery, however shaky, along with cost-cutting, has helped issuers restore EBITDA to 2008 levels. Third, the re-liquefaction of the leveraged finance market has allowed many issuers to push out maturities. Looking ahead, most managers expect default rates to stay in a 1.3% range in 2011, but worry that by 2012 a combination of looming maturities and weak economic conditions might ignite a second spike. To wrap up then, some final points. LCD's forward calendar indicates that volume will continue at its recent pace. At the end of October, there was $19 billion of loans on the visible calendar, right inside the recent range. On the other side of the ledger, managers say investors continue to embrace loans as one of the few asset classes that offer decent distributions. The others include high-yield bonds, emerging market bonds, and high-dividend stocks. Loans, moreover, offer some protection against rate increases as well as collateral protection. Repayments from bond takeouts, M&As, and IPOs also fueling demand by pouring money back into CLO coffers. After a stunning rise, then fall, default rates appear to be settling in a 1 to 3% band. While most market players are sanguine about 2011, however, Further out, managers worry that an economic double dip or an exogenous shock may knock the loan market off its axis once again in 2012 or 2013. That brings us to the end of our overview. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each is in the description of this video below. As mentioned, you can also download this presentation at slideshare.net.